Hi guys, I am Kim Tubil, and for this video, I'll be talking about target capital structure and business and financial risk. Before talking about target capital structure, we should know what a capital structure is all about. So a capital structure refers to the mix of different sources of finance used by a business. And it focuses on the balance of that finance provided by debt and equity, be it bonds, stocks, preferred stocks, like common stocks and preferred stocks, or loans. So firms can choose whatever mix of debt and equity they desire to finance their assets, so long as their investors are willing to provide such funds for their firm. Know that there is no right or wrong for a capital structure. That is why it takes a lot of analysis in order to arrive the optimal capital structure. So this is why firms or most firms establish a target capital structure. It believed is optimal, which will be used as a guide for raising funds in the future. So when deciding for a target capital structure, there are four primary factors. First is the business risk. Second is the firm's tax position. Third is the financial flexibility of the firm. Fourth is it has something to do with managerial attitude, like a conservatism and aggressiveness of the manager. First, business risk. So it is the inherent danger the firm's operation will have to face if it used no debt. The greater the firm's business risk, the lower the amount of debt that is optimal. Second key factor is the firm's tax position. So they have to carefully think their decisions, like using of debt makes a tax deductible, which lowers the effective cost of debt. Or, if a firm's income is sheltered from taxes by accelerated depreciation, its tax rate will be low, causing the firm to have an additional debt with a higher effective tax rate. So, a firm has to carefully weigh things properly when it comes to its firm's tax position. The third important consideration is financial flexibility. So it is the ability to raise capital on reasonable terms under adverse conditions. Fourth factor has to do with managerial attitude, like the conservatism or the aggressiveness with regards to borrowing. So some managers are more aggressive than the others. Hence, some firms are more inclined to use debt in an effort to boost profits. So these 4 points largely determine the target capital structure, but operating conditions can cause the actual capital structure to vary from the target at any given time. Moving on to our next topic, the business and financial risk. So there are two types or two dimensions of risk: the business risk and the financial risk. So business risk, it is the most important determinant of capital structure, and it represents the amount of risk that is inherent in the firm's operation, even if it uses no debt financing. So it is also a business risk is also independent of the amount of debt a business owes or a firm owes. So there are two types of business risk: the systematic risk and unsystematic risk. So the definition of each type is at the screen. So yeah. So the systematic risk does not have a specific definition, but is inherent risk existing in the stock market. So the unsystematic risks, on the other hand, so these are the risks which are existing but are unplanned and can occur at any point in causing widespread disruption. Business risk depends on a number of factors, like the demand variability. It is an uncertainty about demand or sales. Second, the sales price variability, so the uncertainty about the output prices. So the input cost variability, so uncertainty about costs. So, fourth is the product. So, and the other types of liability. And lastly is the competition. So the financial risk, so it refers to the chance a business cash flows are not enough to pay creditors and fulfill other financial responsibilities. So it relates less to the business operation themselves and more to the amount of that a business incurs to finance those operations. So it is also an additional risk concentrated in common stockholders as a result of financial leverage. So, know that the more debt or more financial leverage is, the more riskier your financial in your firm is. So, the more debt will concentrate the business risk on stockholders because debt holders do not bear business risk in case of no insolvency. So to summarize everything, here are the differences on both business risk and financial risk. First, the business risk is purely operational, while the other risk is related to payment of debt. Second, business risk isn't avoidable, but financial risk is. If the firm doesn't take debt, there'd be no financial risk. So third, business risk will be there as long as the company operates, while financial risk would be there until the equity financing is increased drastically. Fourth, in handling business risk, firms must systemize the process of production by minimizing its costs, its operating costs, or any production costs. So while on the other hand, handling financial risk will be through reducing debt financing by increasing equity financing. So fifth and the last, in its measurements, business risk, when there's variability in earnings before income and taxes, and in financial risk, we can look at debt asset ratio and financial leverage multiplier. So I hope you learn a thing or two from this video, and thank you for listening. Bye!